So the doors are open. So this is good. I'll let everybody get in here and then we'll get some things started here. So make sure everybody's got their Jimmy Johns. So I should ask Tony, how many orders did we have today?
I think we had 15. I'll double check though.
No, it's okay. So yeah, that's good.
It was around 15 or 20. We've got a lot of registrants, so we're excited.
Yeah, super excited. So super excited. Tim's a little shady. I should have told him that he showed up just a touch dark. Like you need light in front of you, but that's okay.
Let me see if this helps.
I should have said that to you earlier. So let me open up the chat. So I got the chat box going. So that's good. Getting everybody in here. That's a little bit better. I could see. Oh wait, it's went away. I could see some facial features. So that's a beautiful thing.
I don't know if this light will stay on a permanent basis. It's not reliable.
That's good. Hi, Darlene. So, hey, Matus, saying hello to everybody. John, how you doing? So we're getting everything rolling. We open the doors. We're going to get started with just some basic things in here. So one of the things is welcome. This is our regular series, our monthly virtual lunch and learn. So we've figured out a way to send food to you guys and still make sure we bring quality education. We're super excited today. We've got Tim Edwards on here today and could not be more excited just because I don't get to talk. Tim's going to run most of it. But as you guys know, you guys can ask questions as we go. We did a little practice session yesterday, and I feel like we could have renamed this because one of the key points that we'll talk about today is how to use mortgage insurance if, in fact, you have a short appraisal. So this is the place if you want to know a little bit about mortgage insurance, you want to be a little bit better educated for your clients, and you want to learn how mortgage insurance can help you today. You've landed in the right place. Welcome. So with that, how this works is it's going to be us and our PowerPoint. You guys will be able to communicate in the chat. The chat's already kind of popped up and gotten a little lively, which is good. We invite questions. We think if you guys don't ask questions that you left the building, we don't like that. So we're going to be asking questions, probably maybe polling some people. Mortgage insurance, trust me, you guys will have a lot of questions. Although Tim, I believe, is here to clear that up. Tim, introduce yourself to our fine group here.
Okay, can you hear me now?
Yes.
So hello, everybody. Tim Edwards. I work for MGIC. It's a private mortgage insurance company. I've been in the business since 1986, done a number of things over the years. What that really makes me is an old guy, but certainly experience in this business because I've spent a lot of time with MGIC, competitors, customers, and always like to speak to our customer's customer. That is most cross country is a big MGIC customer of ours, and we don't often get the chance to talk to borrowers or realtors, and so we welcome this opportunity. Glad to be here. I know it's not the most exciting topic in the world, but it's a necessity of life in mortgage lending. So just want to teach you a couple of things about our product, how to use it, give you a little background on it, and hopefully leave you in a better place with a better understanding of what we do. So.
Well, and you know, you talk about not exciting, and I'm sure you'll talk about this a little more, but I mean, ultimately, Tim, without this product, everybody has to come to the table with 20% down. This is why you have to have mortgage insurance. And so, you know, if you don't have mortgage insurance, everybody's at the table with 20%, and we know that's going to take a lot of buyers out of the market. So.
Yeah, I agree. And it's a private sector alternative to FHA too. So it doesn't, and we'll get into that.
Yep. Yeah, we don't want to jump the gun. So yeah.
With that, can I share my screen?
Absolutely. Go ahead and take over.
All right, so I'll start to drive the car here. Let me get there. Go into presentation mode. Okay. Shrink. Can you see the presentation okay?
I've got it. It looks good.
And is my Zoom box covering anything, or do you have the presentation?
No, it's full presentation. I think we're good. So,
All right, well, I'll get it started. Welcome again, everybody. And hey, I'll be formal in my presentation, but this should be informal in that feel free to interrupt, ask questions. And Richard, maybe you can catch them in the chat box.
yeah, I'll monitor the chat box. I'll let you take lead on the PowerPoint. I'll monitor the chat box.
Okay.
And everybody can see it. So we got some feedback already on the PowerPoint.
Okay, cool. So as I mentioned, Cross Country is a big customer of ours. So glad to be here, glad to help out. Going to take a little different approach today than maybe what you've seen in the past. I'm going to actually teach you what our product is, how to use it, and maybe some other things that will help you understand it. But first, a little background on the company called MGIC that I work for. Here's some bullet points that kind of give you a little background. We're up in Milwaukee, Wisconsin. So I'm the sales manager for Illinois and Wisconsin. So a local person, but our headquarters is in Milwaukee, so just 90 miles up the road. We trade on the New York Stock Exchange under the symbol MTG. And as Richard alluded to, and I maybe mentioned a little earlier, we were established as an alternative to FHA lending and the bureaucracy that was associated with it back in the day. So in 1957, a guy named Max Carl in Wisconsin started MGIC and essentially started the modern day private mortgage insurance business. We've grown and shrunk over the years. We're currently at about 7.3 billion in assets. That's sitting in a closet up in Milwaukee, Wisconsin, right down the hall from our president's office. But I say that as a joke, but also as an insurance company, we take risk through our insurance product. We actually don't take risk that much in our investment portfolio. So while I say it's sitting in a closet, it's actually invested in very low risk, AA rated or better investments. So it's, again, we take risk through our business, not through investing. Our investments are very conservative. Last year, as part of the large mortgage and real estate market, we insured over 120 billion in mortgage balances. A record year by far, actually, and 2020 and 2021 were very big years for the mortgage business and for real estate agents and for the mortgage insurance business. So we had a big year. That's how we get measured, by the dollar amounts of mortgages that we insure. So last year, big year for us by a mile. Our portfolio of loans we've already insured grew to 274 billion. And that's about 1.1 million loans. So that's 1.1 million homeowners, mortgages, households, if you will. And you can do the math on that. That's an average loan amount of probably 250-ish thousand. As far as an insurance company, we're rated by the rating agencies. So our best Moody's and S&P ratings are A-, triple B1 and triple B plus by Moody's. That means a lot to certain people in the investment community, not so much to the average mortgage person. And just speaking about supporting the industry and enabling low down payment lending, since the crisis in 2007, 8, 9, whenever you consider it started, but really since January of 2008, we've paid out 17 billion in claim payments. So helping lenders, protecting them as they try to lend and lend to low down payment borrowers. And just the way that math works, how do we pay 17 billion when we only have 7.3 billion in assets? At the time, we probably were up to about 7 or 8 billion. We were taking in $1 billion or $2 billion a year in revenues and paying out a bunch. And it was a race against time. We almost, to be honest, we almost didn't make it. And some of our competitors, our agents in the business, did not. And we were lucky. We made it. We survived. We had enough capital. We're highly regulated. And we have to reserve. And there's all sorts of protections built in so that there's enough money to cover the risk. But got to be honest, it was a close call. But we survived. We're thriving, and we continue to support the mortgage business. So that's background on the company, background on me a little bit. Any questions so far?
No questions. I think John just commented, he goes, MGIC has become a generic term for the mortgage guarantee business, according to him. So that's good. I think he's in tune enough to know when somebody says MGIC, oh, you think PMI.
Yeah, that achieving Kleenex status with your product, where it becomes the industry standard. That actually goes back to the 1960s. And when it was a hot stock and Wall Street loved us and they called us Magic. And if you add a little A after the M, MGIC becomes Magic. So our nickname is Magic. I don't use it, but people who remember us call us Magic. And it's a magic loan. Yes, and for a while we had Kleenex status, but
there you go.
it's sort of
There you go.
faded as time has gone by. So, but that does go back to the 1960s in the stock market. So that's the company. That's me a little bit. Let's talk about the product itself. So what is private mortgage insurance? And I'm going to take this really down to the basics. Initially, not going to talk about underwriting guidelines or things like that. This is about what it is, so you understand why it is. And by definition, it's protection against financial loss due to borrower defaults for lenders that enables low down payment lending. So if the loan's insured, it goes bad, we pick up the loss in some form. And I'm about to explain that to you in excruciating detail, but brief excruciating detail.
Brief. We want brief. That's good.
Here's how it works. And I'm just going to show you a sample claim. Not talking about the borrower at this point, not talking about rates or anything. This is how our coverage works. Let's say you have a homeowner, they buy a house for $148,000. Rich lends them $133,200. That's a 90 LTV loan. And in our business, that needs what's called 25% cover. That's generally required by Fannie Mae and Freddie Mac. So the origination process happens, loan gets insured, borrower makes payments for a couple years, and now something happens in their life, a divorce, a job loss, some economic hit happens, the crisis, and the borrower defaults. And after 6 months of default, the lender is required to file a claim with us. So they initiate foreclosure and then file a claim. And these are real claim numbers from an actual claim. They do vary though. So in this case, that $133,200, it didn't amortize very far. First year or two, there's not a lot of that amortization. So when the servicer files the claim, it's the $132,949.89. It's the outstanding mortgage balance, some delinquent interest, and foreclosure expenses. Now, in this example, those were the numbers are. In some states with extended foreclosure timelines, those can get pretty big. But in this case, the claim's $144,611. So the servicer fills out a form, they send that to us. We do one of three things. Our analysts do quite a bit of research on the property, the local market, rentals, sales, all sorts of stuff. And they're trying to figure out how we can make cross country happy with our claim payment, but lose the least amount of money. And on this slide are the two major ways that happens. So MGIC gets a claim from cross country and it's for $144,600. We might write them a check for $144,600 and take title to the property ourselves. And then we deal with the REO. We deal with the losses after that. Cross country leaves happy because they've got paid and their loss is recovered. That's option one. It's called property acquisition settlement option. The other option involves that 25% that we saw in the example up front. This was a 90 LTV loan that had 25% cover. So what our analysts do is they calculate this. They take the claim amount of $144,611 and say times 25%. That's $36,152. So our choice at this point is, pay the full claim to cross country, we take the property, or we pay the percentage guarantee claim, 36,152, and cross country deals with the REO. And they're running their math simultaneous to us. They may or may not like this, but it gets them close to being made whole, and we've fulfilled our obligation.
Hey, Tim, I got 2 questions plus 1 from the panelists, but I'm going to ask some questions here. So in these 2 examples, as a percentage, like I would think that the insurance company is taking option 2 almost 100% of the time. Why in God's name would they pay 4 times as much to take the whole property back?
So because what we will do, we're running our own equations and we're going to sell the REO. So we're really not losing 144. Our net will be 144 less whatever we pick up. And we might fix the property up. We might rent, might repair it. We might sell it right away. So
that makes sense, and I'm good with that. So do you know, as a follow-up to that, before I get to my second or third question, what percentage of properties is MGI? If you got 100 claims, how many are going into option 1 versus option 2 as an average?
It depends on the environment, Richard, in that if property values are declining, such as post-crisis, 2008-9, so 11-12, that when we were paying out the claims, when property values are declining, it's generally option 2.
Okay, so today, how many are you taking? Because today, obviously, valuations are up.
Yes. So with valuation, so bottom line, in bad times, our loss is capped at 25%. So
Okay.
yeah, we take the capped loss. In good times, the dynamic switches. Property values are going up. It shifts back to paying number 1.
Okay.
But there's also another dynamic there in that when times are good, there's not a lot of claims because if values are going up, the defaulted borrower can probably sell their house and get out of trouble.
Sure.
It does move around though. That percentage, post-crisis, it was mostly 25% coverage and we ran away, right? It just, we wrote our check and said, we're done. It gets a little more complicated when we take the property and figuring out the math.
So the assumption is you're taking more properties now than you have in the past relative to the answer that I'm trying to get. But so I'm asking for a friend, meaning all of my realtors on this call, who gets, as a real estate agent, who gets to actually market those properties for you guys once you rehab them, take them back?
So
who gets those listings?
Good question, Richard. We're always looking for realtors in local markets.
Okay.
I don't want to get anyone too excited in that there's not a lot of losses right now, so there's not a lot of properties, right? But yes, because when you pay out 17 billion in claims and take some property in and work with local realtors, getting BPOs and doing other things, we have a pretty extensive network of realtors. If anyone wants to get on our list, we always collect names. I just don't want to overpromise and underdeliver. There's just not a lot of activity. When you spread it over 50 states and we're in good times, there's not a lot of work. But eventually we do need help from local real estate agents, either selling our REO or doing BPOs. So if any real estate agents are doing BPOs, in that process, we're pulling BPOs all the time.
So Tim, how would they get their information to you?
Send it to you, send it to me, or send it directly to me.
That's perfect. Okay, good. Actually, Tony just put Tim's information in the contact. So his email, any of the agents that are here, if you're looking to be able to do BPOs for MGIC and or potentially get some REO listings, this is a great opportunity that we just gave you. Tim's information is in the chat. Email him your information as far as that's concerned. And Nia, I think that covers your question. So now that we got off of those 2 things, and I'm glad we can create that opportunity for our attendees, the next thing, so Bobby asks, let let me see here. Okay, this is perfect. So I think what Bobby was trying to get to is who makes a decision, and I actually will answer this, I think, who makes a decision whether or not we're using MGIC or one of your competitors, which are nearly not as good as MGIC. So I would tell you the mortgage lender is making that decision who we're going to use. So whoever you're using, they have relationships with MI companies. We have MGIC that we have a relationship with. We're making that decision to choose MGIC. So I don't know if you want to add anything to that, Tim, but I know that that's how I'd answer that question.
Yeah, our customer is the lender, right? So they're acting on behalf of the transaction and the borrower, and they're just, price is an element, underwriting guidelines, ease of use, service, all those things factor in. And yeah, it's generally the loan officer or it could be a lender policy, a company policy, who their vendors are. But yeah, we're a vendor on the list, and the transaction and the loan officer kind of dictate where the mortgage insurance goes.
Yeah, I mean, the LO could make that decision as well, Bobby. If they happen to see like we're really, really tight on something, it's like, okay, just got to get the best price. We got to make that decision. Generally, we don't find ourselves in a place where we're making a decision based on mortgage insurance underwriting, because I believe we're delegated so that, there's no separate underwriting piece on that. So some other companies, though, may say, hey, we're going to have our own underwriter underwrite it, but if we sell it to, let's say, one of Tim's competitors, they may also have the opportunity to underwrite it, which is problematic in my eyes because it slows things down. So if we're given the opportunity to underwrite that stuff outside of Tim, I think it speeds things up. So
yeah, good point, Richard, in that Cross Country has delegated underwriting with us. So they don't, the old days, they used to send us, a nice 2-inch thick loan file with documents in it, and our underwriters would page through it and make the underwriting decision. Because we have long experience with the people at Cross Country, they've performed well over time. They've demonstrated they know what they're doing. We give them delegated underwriting. So all we get is data, loan amount, sales price, a few other things, and they underwrite the loan and send us data, and we issue the certificate. So it's a pretty slick system with what we have set up with Cross Country at this point.
All right, perfect. So I think we covered a claim. What do you got next on your next slide?
Hey, just one last one on the claim thing. A third option we do is loss mitigation. So that is your typical claim, what I just showed you. The third, though, is, we're trying to lose less money, right? So if we can find a way, if the borrower works with the servicer and they bring forward a short sale offer, and we did a lot of this during the crisis, and in this case, it's a made up example. We're losing $34,000 instead of $36,000. Doesn't sound like a lot, but times a million loans, it adds up. So if the third option is the pre-claim sale, and we're always looking for loss mitigation strategies. In this case, it's a short sale. We do this from time to time. It takes communication with the servicer, the home buyer, the local real estate agents, and sometimes we can lose less money. We are going to lose. It's just a little bit less. So that's it on claims, though. Okay?
Perfect.
So we've got this product. We insure losses. Why do why is it? Why does it get used? There's a couple of answers to that. The number one reason is because you have to. It's a requirement in mortgage lending. It emanates from the charters of Fannie Mae and Freddie Mac, and they provide a lot of liquidity to the market and to Cross Country and other lenders. It's where 80 to 90% of the loans we insure end up in some form, and it's just required. If you read their charters, there's a couple lines in there that say loans over 80 LTV need to have their risk mitigated through certain tools, and one of them is private mortgage insurance. So it's required by Fannie and Freddie, generally speaking. That's generally the answer. There's also capital treatment for banks, savings and loans, and credit unions, portfolio stuff. We do about 10 to 20% of our business with portfolio lenders. And for capital standards, same thing. They need to insure loans. There's certain thresholds, loans over 80, loans over 90. But bottom line is it's capital treatment for banks. There used to be a third reason that doesn't exist today, and that was in the securitization markets. It affected credit enhancements. But since the crisis, the rating agencies have not been confident in that. And so I've lost a third bullet there. We don't say that's a reason these days. We're working on it though. So that's because you have to, right? What you may not realize is you may want to some of the time. There are reasons to use mortgage insurance other than because you have to. If you start to think about it as a tool for the loan officer structuring deals, it becomes a strategic solution. It's not only a solution for the loan officer, but for the real estate agent too. Some quick examples, it allows the borrower to buy sooner. And we're going to demonstrate that in the next couple slides, to buy bigger, to buy other stuff, and a strategy that's come up recently to overcome low appraisals. Doesn't work in all these situations, but it's a tool that can be used in these.
Hey, Tim, before you go on to the next slide, and it's also, and you'll probably cover this, and if you don't, I can, what's that, Tim?
I hope
there
you
you
can
go.
see the text. It's getting kind of small.
Yeah. Hey,
Okay.
Tim, can you hear me?
Yes.
Okay, good. So yeah, no, John also posted out there that it's also a good alternative to FHA. And that's a good, we'll talk about the FHA versus conventional. Do you cover that later? If not, I'll just cover it now.
I can, but I didn't put it in the slides, but yes.
No, I'll cover it. That's fine. So John talks about mortgage insurance conventionally being a better solution than FHA. Currently, under the FHA current guidelines, it is definitely more expensive in most cases, partially because FHA has upfront mortgage insurance and monthly. The upfront mortgage insurance is a one-time fee. It's about $1,750 per 100,000 that gets added onto the mortgage. For the most part, MGIC and conventional doesn't do that. There are some variations where they might be able to, and we'll talk about that in a little bit. But the other issue with FHA mortgage insurance is right now, under the current rules, it's permanent. So no matter what your loan to value is, you're going to pay that as long as you carry that loan. With conventional, you'll eventually be able to get out of it and get it removed from the payment. And we are going to discuss that here. So that's why it's definitely a better alternative. So thanks, John, for the point. And Tim, I turn it back over to you.
Okay. Yeah. And we were started as an alternative to FHA. We still are. Different reasons today. It was bureaucracy back then. Today it's pricing. Today it's cancelability and some other things. Ease of use still applies. But as far as buying sooner, this slide, we're just demonstrating here a story of Isaiah, a recent college graduate buying a house, and it compares doing a 3% down payment loan today to doing a 20% down payment loan tomorrow, or however long it's going to take this person to save 20%. And there's reasons why to do it today or tomorrow, but in this case, somebody buying today is going to, with 3%, they're going to get in for $6,300. 7 years later, they're going to need $51,000 to get in, and all the other implications that come with that, maybe missing out on appreciation, things like that. So mortgage insurance as a tool, as a solution, buy sooner, buy other stuff. In this case, we're comparing just today versus today, do a 20% down versus a 15% down. And, you're going to incur the cost of mortgage insurance, but there's some things with loan pricing where you actually get a little better interest rate moving from 20 to 15% down because of Fannie Mae requirements with the introduction of mortgage insurance. And just bottom line, if you need the money, doing a 15% down is a relatively cheap way to finance the other stuff. Now, that could mean you go buy stocks, you invest the money, but for the new homeowner buying a house, that in this case, the $17,000 difference, they're buying curtains, they're buying the new stove, they're fixing up something on the house. So it's, again, a tool here to free up some money to use it other than down payment. And it helps home buyers as they get into the home.
Yeah, and one thing I want to talk about that you brought something up, Tim, that people are very, very unaware of, and it's somewhat counterintuitive. A lot of people think, okay, I got to get to 20% down because that's just going to give me the best possible deal. Well, yes, if you get to 20% down, you will not pay Tim's company for mortgage insurance. However, Fannie Mae may not think that's the best deal for them, and I'm going to tell you why. With 15% down, Tim's company will insure the lender to a risk of 72% of the value of the purchase. So just round numbers, $100,000 house, client comes in with 15,000, MGIC is right behind us insuring my risk to 72,000. Now, your client who thinks they're going to get a better deal by going to 20% down, they're bringing 20 grand in, but my risk went from 72,000 to 80,000. Fannie Mae actually will charge a buyer more for 20% down than they will for 15% down. It's very minor, but they will charge a little bit more. Sometimes it shows up in the rate, sometimes it doesn't, but it is definitely a little more expensive to be at 20% down than at 15 because the risk is 72,000 versus 80,000. So anyway, go ahead, Tim.
Yeah, you're bringing up the concept exposure, and at 80, Fannie Mae's exposure is 80.
Yep.
But at 85, because of our insurance, their net exposure is 72. They feel more comfortable with the loan, so they price it a little better.
Yep.
Counterintuitive, as you said. So, but yes. So we're demonstrating here a little bit of that and a little bit of, hey, it just frees up funds. Yes, there's a price. Your P&I is going to be a little higher, but you do have room now for the other things you may need to spend money on as you buy a house.
And maybe it's even just to start a reserve account, leave some of that money as an emergency account. You're a homeowner and somebody's going from an apartment to home ownership, and we know things happen with the home like furnaces, water heaters, things of that nature. So the point of the matter is we can talk to them about maybe paying a little bit more, but $17,000 for most people is probably 3 months worth of an emergency account. That's a really good place to start. Speaking of that, it's a really good segue. This Saturday, we are having a virtual class between 9 and 10 that's entitled "We Got You Into Debt. Now Let's Get You Out of Debt." It's for newer homeowners, but certainly any homeowner can come to that class. And we definitely talk about immediately start working on your emergency fund once you close. So there will be a link to that class in the chat. But if you have any new homeowners that are interested in that, it's a phenomenal class to, hey, you're in the house, here's what's next. And it's kind of our commitment to be more than a mortgage to our clients. We're going to be there for them afterwards. Go ahead, Tim.
Okay. So yeah, other stuff, whatever that means, right? It's money for lots of uses. The other one I'll touch on here, and I can go on forever, but I won't, is using our product to overcome a low appraisal, which we've run into the last year or two as values have gone up and maybe appraisals haven't caught up with them. So in this case, look at columns 1, 2, and 5. Column 1 is borrower came into Richard's office, wanted to put 20% down. Those are the numbers. Buying a $400,000 house, 20% down is 80,000. That's how the numbers work. Appraisal comes in low. If you just go with it and not consider MI, it changes the dynamics. 20% down, to stay at 80 and cover that additional piece. If the appraisal comes in lower, the 20,000. Down payment now goes up to 96,000 to be at an 80 LTV. So the borrower needs to come forward now to solve the appraisal issue with $16,000. we get a little carried away with our examples. Ignore column 3, column 4. Column 5 is the one I want you to look at. What we do there is say, okay, let's use mortgage insurance instead. Freeze the down payment at 80,000. Do a 85 LTV because the appraisal came in low. Doing the same loan amount. Yes, you're incurring the cost of mortgage insurance. Yes, you're taking out a slightly higher mortgage. You do get the benefit of what Richard described with the Fannie Mae pickup, but you save your deal. Your bottom line is for a similar housing payment, slightly higher LTV, you are kind of saving the transaction and keeping the borrower in a similar place. So we've done a lot of this the last year where loan officers have structured deals and to save on a low appraisal, they've gone this direction.
Yeah, so a little bit of mortgage insurance in here at $37 a month. They're not bringing in the extra $16,000. And even worse, what if they didn't have the extra $16,000? And we've got a seller in here that says, hey, I'm not changing a damn thing because there was a line of people behind you that wanted to pay that for this house. So we're not coming down. So now your buyer's in a situation where they don't have the $16,000. This extra $37 a month is all it takes to keep that deal together, guys. So that's really, really important to note that mortgage insurance in a very little bit might be the answer to keep your deal alive. So if anybody has any questions about that or a yippee or a whoop whoop, put that in there because I'm telling you, you're talking about saving a $400,000 transaction in this market and keeping your people into the deal. I think this is a huge, huge deal. So
yeah, so hey, why use MI? Because you have to, but also because you want to. And there's other kind of situations where it may apply. Not going to go into them today, but this is just an excerpt from one of our brochures where we talk about it. So, but the ones we looked at, buy sooner, buy other stuff, save a deal with a low appraisal, they apply. It's real stuff. So
absolutely.
Moving on. Going to talk about the origination stuff a little bit. How do you pay for mortgage insurance? Most common is monthly premiums. That's what's evolved today. It's used about 93% of the time. It's an annual number, but it gets divided by 12 and it's in the PITI. So it's in the second I of PITI. Policy renews annually, but it's in the borrower's monthly payment. It's called a monthly premium. We do about 7% of our business as single premiums. That's taking a lifetime of expected premium and paying it all up at once. It's for life of loan coverage. It's on the surface expensive, but there's reasons people do it and there's ways to pay for it that softens the blow to the borrower. On a side note, if anyone really cares, this is what data cross country has to send us to get a rate quote, whether it's a monthly or a single premium. You know, we work off of LTV, loan amount, credit scores, is it attached, detached, condo, primary residence, second home. This is just kind of the stuff to get a price. All right.
Hey, Tim, I want to stop there too real quick for people because, and also Nia, I'm going to address your question too, but prior to the housing crisis, a lot of this stuff they're asking wasn't part of the question and answer. You remember the rate cards, Tim? So we had a rate card that said, oh, is the loan to value this? Cool, that's what you get to charge. And the only variance typically was, is it an ARM? Is it fixed? Or are we doing a specialized Fannie Mae product like Home Ready or something like that? Subsequent to the housing crisis, we now factor in, not we, but the mortgage insurance companies now factor in things such as, is there more than one borrower? Yes, in fact, that does change your rate. How are their credit scores for the borrower? Yes, that actually will impact their rate of mortgage insurance as well. And then you could see the other things that are on here that could very well impact the cost of mortgage insurance. So if somebody says, well, hey, mortgage insurance quoted is like $30. Cool. What do you know about the borrower? Nothing. Well, that mortgage insurance quote is probably not good because just like us being able to quote an interest rate, I have to have a hell of a lot more information to make a diagnosis. You don't call your doctor and say, hey, I got a cough. What do you got for me? He's going to have questions. How long's the cough? How deep's the cough? What are your other symptoms? Same thing when we quote an interest rate. Same thing when mortgage insurance these days has been quoted, is what are the other components so I can get you the best mortgage insurance rate? Now, Nia had asked, is this something that can be used in conjunction with FHA? Regrettably, the answer is no. Private mortgage insurance is just that. It's for the private non-government loans, specifically Fannie Mae and Freddie Mac. So unfortunately, these solutions don't really apply to FHA loans. Go ahead, Tim. And I know you were in the middle of explaining the chart, but I think it's important that people know exactly why we're looking at this thing here.
Yeah, and real quick, not FHA because we're an alternative to FHA. But also you mentioned something worth noting, these typical pricing elements for a lender or for interest rates for mortgage insurance. What is new is the number of borrowers. We've had history of better loan performance when there's more borrowers on a loan. So one borrower versus two, when there's two, it gets a little better rate. So that's something that's really come about the last few years too, as Richard mentioned. So somebody gives us this data, we give back a price. That data that was in there actually produces this price. So the monthly premium in this case is 55 basis points. That's loan amount times the rate, 0.22 divided by 12. Or a single premium of $2,700. Now, on the surface, $2,700 knocks your socks off when you're a low down payment borrower. But there are reasons to do it. And, some of them, and this would be something for Richard maybe to address, if not now, at a later date with you about why you do some of this stuff. But sometimes it can be rolled into the loan amount. So a $100,000 loan becomes a $102,000 loan. Or when there's other money in the transaction to spend, a lender credit, a seller credit, employer or reload contributions, if there's money to spend, spending it on your MI changes the dynamics of the equation. And all of a sudden, $2,700 up front isn't a lot of money because it's been paid for by somebody else. I won't talk about a realtor credit. That's for
yeah, don't tip them. Don't tip into anybody's pockets, even my pocket. But yeah, I want to talk about that for a little bit. I'm glad you brought it up, and then we're going to address John's question in the chat. Yeah, other sources of funds to knock out that $2,700 in case. First of all, we would do the $2,700 if that $55 is something that actually pushes them out of qualifying. So, okay, the $55 pushes them out of qualifying. Now, what do we do? Maybe some debt came up at a later date. Maybe during the verification process on the employment side, income wasn't what everybody had presumed from the literal verbal application. So there's some things where the mortgage insurance, even though it's $55, it might trigger a denial. So how do we fix that? We can do a single premium. Now, how do you fund the single premium? That's the question. Lender credits typically could be used. Now, similar lender credits also are kind of markets sensitive in the sense that since the market started whipsawing and rates started their ascent up in late December, we don't have as much premium to play with because Wall Street now they're seeing big daily swings. So when they're sending money to the lenders, they're like, we may not pay you as much because by the time we issue something and we actually secure it, the rates could change 40 basis points. So the moral of the story is because the market is volatile today, we maybe don't have as much money to get access to by raising an interest rate where maybe I could raise it a quarter and very easily get a point to cover that 2,700. Now I might have to raise it 3/4 of a point where it just doesn't even make any sense. So a lot of that extra money isn't there. Will it change? Yeah, it will. It was stable before December where we would have money there. And I think once the markets stable out, that will come back. You guys all know seller credits today is really, really tough. in this tight inventory market. So that's another place that while we've listed it on the slide, we know that doesn't always happen. Employer reload contributions, yeah, I mean, maybe, on the few that we see. I do want to address something, and I'm going to let Tim answer to this. John wanted to know for 80% LTV, over 80% LTV loans, is it available on non-owner occupied properties? And essentially, we would just be talking about a single unit, but go ahead.
That eligibility has ebbed and flowed over the years. Our primary purpose is, residential lending, enabling home ownership. So currently, there's not much availability for investment properties over 80 LTV with mortgage insurance. A lender might do it without us, but likely not. Fannie and Freddie don't really allow it.
Well, you could put as little as 15% down on a single unit non-owner occupied through Fannie. So if you could put 15% down, that is going to create a mortgage insurance. And I would tell you the mortgage insurance is definitely going to be more expensive because it is non-owner occupied.
Yeah, and that eligibility for us ebbs and flows. Coming out of the crisis, we stopped doing investment properties. We may have inched back in. We used to do them to 95. And then it was 90, then it was 85, then it was 80, then it was 75. And if we've
it's
85, I just don't see it very often. So
yeah, it's 80, it's 85. I mean, part of the reason that, Tim, you probably don't see a lot of the 15% down on the non-owner occupied is even though Fannie Mae is insured, they really don't like it either. So the pricing for it is really, really obnoxious. So they might be trying to add like 3.5 points, which if we're burying that into interest rate might mean that we're offering non-owner occupied rates in the 5s today. So to try to bury 3.5 points, it's tough. So, but anyway, all right, let's move on our program.
So, and how are we doing on time, Richard? Because I think we're running low here.
No, we're good. 12:45. It's good. And you know what? We had questions about this. How can a borrower cancel MI? I know agents are getting this question. So other than us providing so far in value a way for you guys to possibly get listings for mortgage companies, also showing you a way to handle a low appraisal, I think this is probably the third best nugget in today's presentation. So go ahead, Tim.
Yeah. So whether you have MI because you had to have it or because you strategically chose to have it, the reality is the second the borrower closes on the loan, they'd like to cancel the insurance and get rid of that $55 a month, right? Well, there's a reason it's on there. It's protecting the lender. We've paid out $17 billion in claims in the last 10 years. So it has purpose, but there are times where it should be canceled. And here's the game. I'm going to show you this piece, and we can send you a more formal follow-up item that'll walk you through this. But bottom line, here's how it works. Two things. Are you trying to get it canceled based on the original value at closing or on some future value? And you'll hear that's via appreciation generally. And it's weird. There's a term some Fannie and Freddie use the term current value, but sitting here today, current is to me the original value, but future or current value in the future. So, original value based on amortization, you got to get down to 80 LTV. So the borrower makes their payment every month and the balance comes down. When they reach 80, the insurance can be canceled. If they decide to prepay it, they not just make their monthly payments, but they come into lump sums of money and pay it down to 80. It can be canceled. And then there is also automatic cancellation by the Homeowners Protection Act. It's required by law. When that loan reaches 78 LTV of original value across country, MGIC is required to cancel the mortgage insurance.
Original value based on the value at the time that the loan was started, whether it's the purchase price or the appraised value in the case of a refinance. So
correct.
Yep.
All right. And there are some things attached to that, like you need to be paying on time. If you're delinquent, they're not going to let you cancel your insurance. If values are tanking in a certain market, the servicer might hold back. But bottom line is this is when it should get canceled. So that's original value. Then future value, borrower closes on a home. It's a hot market. Values are running up 10% a year, or not. It's something more mild, but it needs to stay in place for a minimum amount of time. Fannie and Freddie rules say 2 years minimum for future value. You can't close it, get an appraisal in 3 days and say, hey, cancel it. It's got to be in place for at least 2 years. And for years, from years 2 through 5, if you're at 75% of value, it can be canceled. 5+ years, 80% of value. Okay.
So let me go back to based on original value, since you had that 2-year limit based on future value. If somebody came into a sum of money and prepaid it down to 80%, but maybe they came into the sum of money in 6 months, that would allow them to drop it before the 2 years?
Absolutely, because you're going
Okay.
off original value. Yeah.
All right, perfect. Let's see, we got some good questions coming in. I knew this would be a good one here. So does the homeowner need, okay. Does the homeowner need to pay for an appraisal in order to get the MI removed in future value? I know the answer, Tim, but I'm gonna let you answer.
Okay. Well, when it's future value, it's a little squishy. So the borrower has to contact their servicer and request the cancellation. Fannie Mae and Freddie Mac, and that's generally who we're talking about here. They need some way to confirm value. It could be a BPO. It could be an appraisal. They have to somehow find out a legitimate value to justify the cancellation. So
Yeah,
there is.
And I just had a client call cross country. And so when they called, because we service our own loans here in Chicago, she knew the values were up. They had paid the principal down a little bit, but they wanted to use future value to drop the MI versus amortization. And they called and they were given the name and number of an appraiser. They paid the appraiser directly. Appraiser came out. The report went back to us as a servicer, and then we removed the mortgage insurance. Much cheaper way than doing a refinance because you're just paying for the appraisal, which is good. Again, where this doesn't work is FHA, which is why conventionally is the mortgage insurance is much better than the FHA currently. And I said that currently a couple times because they're finally talking about the fact that the FHA fund may be more solvent than it was since the housing bubble, and they may be eventually making some changes to the FHA insurance. So does one of those changes mean that they'll eventually start dropping it down the road? I don't know. As current laws sit, FHA mortgage insurance is permanent.
And the value of our product relative to FHA changes over time. It's based on where we are, where the government is. And today we're probably a more attractive solution in this example.
You're definitely a more attractive solution. So,
but that can change over time. So
you've heard that before, though, Tim, right?
Yeah. Not often enough, right?
There you go. There you go. So what else do we got on helping borrowers cancel MI? Did we cover this?
Well, just a couple of things to know.
Oh, good.
The MI companies don't cancel it. We can't. We're obliged to keep it in place. We're stuck forever. I'm exaggerating. The servicer cancels it. It's up to them. Borrower makes the request to the servicer. Got to have a good pay history. Servicer may need to confirm value in some form, and it's going to vary from shop to shop. But when you listen to Richard's example, okay, you got to spend money on appraisal. I don't even know what that costs these days, $400, $500, $700. But versus the 55 or 100 a month you're paying, you're looking at your break even's only a few months out. If you want to get rid of it, it's worth giving it a shot. And we're running cancellations all the time. It's not that difficult. It is a mystery though. That's why we're talking about it today. So,
not anymore. If you were in this class, it's not a mystery. So
there you go. All right. That's really it on the product itself. You know, we talked a little bit about the company. We talked about my favorite subject, me. We talked about canceling, how to pay for it. So that's all great. We do some other things though that just help the industry. And we have some tools for the real estate agents that you may find useful. I just want to talk a couple minutes about our consumer facing website. It's called readynest.com. The MGIC website is mgic.com, but we also have something called readynest.com. It is about getting homeowners ready to buy a house, help them understand the process. And there's lots of tools and stuff in there for people to use. You as real estate agents have access to this. This is a public site. And I'm just going to take you on a quick drive there. Let me minimize this and move to the internet. Hopefully it works. That's not what I was looking for. Hang on, Richard, I'm having a little
Yeah, no problem.
technical difficulty here. For some reason, I'm not getting.
Yeah, I pulled it up too, but I'm sure you want to walk through some stuff, so I'm going to let you run that.
Yeah, let me get, for some reason, I just went into work mode. I don't know why.
Yeah, I was going to say that looks like the screen when you're logging in the first time. So well, you might be getting there. Nope. So yeah, we went on to Ready Nest when Tim and I kind of did our, we usually have a meeting before we do these presentations. And I know the couple things that were on there that I liked were certainly the home waiting. Let's see if I could find it on that website. There was the resource, I think it's under resources, calculators. Yeah.
I'm having trouble here, Richard. My computer's locking up all of a sudden. So,
Oh, that's not good.
yeah.
That's not good. Well, I got you and we could still hear you. If you want, I'm going to actually, let me find out from Tony. Oh yeah, I could still do, I think I could do a share screen, but I might have to bump your share screen off. Let's see if I can do that. And then I'll show you guys what, actually we'll do this, share screen. I'm stopping your share screen. Sorry, partner.
That's fine. I can
just took you out of the equation, but you should still be there. So that's good. All right. So you still there, Tim?
Yeah, I'm here. And actually, if you bring me back, I think I got it.
Okay. Yeah, you got it, buddy. Let me stop the share there and go right ahead.
Nope, it locked up again. Sorry.
Okay. All right. No problem. I'm going to take over real quick. So Ready Nest, I think the one that you guys will like the most is, this is the one that I found a lot of value in. So first of all, let's scroll back to, let's go back to the home page just so I could show you guys really quick what it looks like. I could probably back up through here. So there you go. So you got readynest.com, not that difficult. You guys go here. The one that I really like, because I think right now the biggest challenge we have is just keeping people in the game, you know, realizing that, you know, they may have to make multiple offer versus multiple offers. So how do we keep them in the game, and how do we show them how do we show them some of the stats and have them not think we're trying to sell them? So I like, you go into this affordability calculator. There's this is what I want, right? Buy now versus wait. How am I doing, Tim? Perfect. So buy now versus rate, wait calculator. And so, oh, actually, this is the one. This is, well, yeah, sure. I mean, you could do this too. So it talks about what your monthly rent might be at, we'll say average rent at 1,800. And for some reason, I think this was the median rent in Chicago. That's why I picked that number. So your monthly savings contributions, tell me how that part works.
But
Tim, just how much money you're going to put aside every month?
yeah, what is it that if you're calculating, okay, if I'm going to buy now or wait, you got to kind of do it based on how much money you have and how much you think you could save over the next few years. So
got it. And home price, we'll say we're looking at about 250. Amount I can afford in a down payment at 250. We want to be at 9. We're going to bump that up to about 12. Estimated interest rate, we're going to bump that down to about 4.25. So there you go. So rather than wait, so what they're saying is based on, okay, cool. So based on what you could save every month versus buying now, it could take you 9 years to buy. But you could buy now with as little as 3.5% down or 7,500. And it starts going through, you could have $12,000 down today versus 64,000 that you'd need to save for 20%. And they also talk about what that home might be worth and appreciation. That $250,000 home 9 years from now would be at 322. So this is a quick little thing that you could show somebody is, hey, this is going to cost you a lot more to wait. So I do like that. Is there another calculator you wanted to show off on this?
Hey, actually back up to just the entry page, readiness.com. I just want to point out a couple of things real quick.
Yep, we can do that.
All right.
Go ahead.
So if you could hover over readiness.
Yep.
We should get some drop downs.
I think this is what you want me to hover over here. Is that better?
Yeah, all right. This is weird. It's actually presenting differently. But under get ready, just want to tell you what this is for the real estate people. This is stuff to get the home buyers ready to buy a home. You can come in here and download this stuff, steal it. We're not copywriting it. We like to encourage informed home buyers, responsible home buyers. So getting ready to buy a house, just click on credit reports, just credit basics. This explains to the borrower what a credit report is and why a credit report is and what goes into it, what goes into a credit score. So if you need help with this, talking to your borrowers, we've got stuff on this on our website. So that's the get ready. That's
I'll go back. Sorry.
I mean, you can see all the topics in here. This is prepping a home buyer to get ready to buy a house. That's
Perfect.
Click on the process for me, if you would. This is what's gonna happen as you go buy a house. And you might want to click on what to expect with a real estate agent. It's a dangerous subject for this call, but I don't think we say anything bad there. But it's telling a borrower what to consider as they get ready to buy a house. And now they got to go choose a real estate agent. How do you do that? Where do you find out stuff? So there's that. That's the process. Then the next one, at home. This is, all right, now you own a home. What are the responsibilities of home ownership? Get ready. You've got to maintain a house. You're not renting anymore. You're responsible when the furnace breaks down, things like that. So and there's canceling MI in there again.
Yeah, that's great. The canceling MI, you could send them right here, like, hey, or just go refresh yourself to go here. So this is good. Hey, Tim, since we're at 1 o'clock, I'm going to stop the share and we're going to kind of wrap this up. Any other questions that you guys have on MI, let me know. We have some future classes coming up this month. So on Saturday, we already talked about it. It's our financial, it's part of our financial wealth series, which is going to be, we've got you in a debt. Let us get you out. That's Saturday Zoom via 9 to 10. Tony's already put a link in there. On March 16th, we have a home buyers class. That is a Wednesday. Every month we do a home buyers class. 1 month it's during the week. The next month it's on the weekend. This one happens to be Wednesday from 5:30 to 6:30. If you're working with anybody or even any leads you have, send them to our home buyers class. We walk through the process. We take about an hour, educate them about everything that they need to know about home buying. On the 19th, the last one we have for the month is we will have Jim Drusky on from Illinois Credit Services. This is one that we've done them in the past where it's realtor only or borrower only. This one is pretty much open to everybody. So we won't be talking about necessarily realtor specific things, but Jim's phenomenal. He's an expert witness for credit in federal court. He's got a company here called Illinois Credit Services. They're based right here in Plainfield. We've used Jim for a dozen years, no complaints, very reasonable. Everything you want to know about credit. If you've got credit challenged borrowers, buyers, leads, send them to that class on March 19th. All the class registrations are listed in our chat. You guys can click there. If you aren't able to get to the chat, maybe you're listening on your phone or whatever, just email us. We'll get you into the class. Tim, I wanted to thank you very much for your time. Tim's actually in Florida right now on a little bit of a vacation, but he agreed to do this. Oh, never mind. We weren't there. Never mind. He's not there. I didn't say that. So that all being, what's that?
Just thank you. It's nice to promote the product and inform people. And one last thing on readiness, what I didn't get to point out, sorry about the technical difficulties. If anyone goes to that website, the other neat thing about it, in the very upper right-hand corner is an Espanol button, and it puts everything into Spanish language. So
That's awesome.
Yeah, but hey, glad. I hope it was informative. We do these things for our good customers like Cross Country, and hopefully you find value in it and find Richard's your guy for mortgage financing expertise. So thank you.
Perfect. Yeah, I did see the Espanol thing in there. So that is in the upper corner. So thank you guys for coming. Hopefully we'll see some of you guys on Saturday. And Tim, thank you again for doing that right here in Chicago. I don't know anything about those other places you could be. Bye, guys.
See you, everybody.
Take care, guys. Thanks for attending, everybody.